You know the investment property is starting to own you when this text ruins your mood before you even open it. Now you already know this quick question is somehow going to cost you $4,000. And honestly, I think social media tricked a lot of people into buying real estate for emotional reasons. Because online it looked like freedom, wealth, passive income, and in real life, sometimes it's you just Googling, can mold spread through vents at 11:43 p.m. while sitting in a Home Depot parking lot eating beef jerky. So I want to walk you through 5 mistakes that people usually stop making only after real estate emotionally body slams their into maturity. Mistake number 1, buying because social media made them feel broke. I swear, there was a period where the internet made owning real estate feel less like a financial decision and more like some weird adulthood emergency. Your coworker suddenly had an Airbnb, your cousin became a multi-family investor, random dudes with the weird haircuts were yelling, "Passive income changed my life, bro." And after a while, it starts messing with your head a little. Even though you know that the social media is exaggerating things, eventually you start thinking, am I behind? And honestly, that feeling alone caused a ridiculous amount of bad decisions. I know a guy who bought a duplex with almost no reserves because he was completely obsessed with the idea that if he didn't buy immediately, he'd miss the market forever. Closing day, best day of his life. Posted the keys photo on social media, parents were proud, friends commenting big moves and generational wealth, etc. But 8 months later, this is the part that nobody posts online anymore, because buying the property is fun. Owning it, completely different emotional experience. You know it's getting bad when your property manager texts you during dinner and suddenly your chicken parmesan tastes financially stressful. That's the real estate. And honestly, I think after enough people go through situations like this, they eventually realize something really important. Not buying something can absolutely be a smart financial decision too, because movement and progress are not automatically the same thing, especially when the movement is panic disguised as ambition. Mistake number 2, falling in love with a spreadsheet version of the deal. This mistake catches smart people constantly because spreadsheets make everything feel weirdly safe. The broker package looks beautiful, renovation budget feels manageable, upside looks obvious, and then the ownership starts. And the property immediately begins behaving like a raccoon with anger issues. The contractor disappears halfway through the renovations. The city suddenly wants permitting that nobody mentioned before. Insurance jumps. Tenants start acting personally offended that renovations are happening in the building. And slowly you realize this thing that looked amazing on Excel is now affecting my blood pressure. That's an important realization, because a property can absolutely make sense mathematically while simultaneously making your actual life worse. And honestly, I think new investors imagine experienced investors are calmer because they found magical deals. Not really. Most investors just stop romanticizing the business after enough chaos. That's it. Real estate is basically constant problem solving, wearing a Rolex. And this is why I always tell people to run what I call the peace test before buying a property, which goes like this. If this becomes just 30% harder tomorrow, does my life still feel okay? Not would the deal survive, would you survive emotionally? Because some investments don't technically bankrupt people. They just slowly transform them into exhausted weirdos just pricing water heaters during the date night. Mistake number 3, borrowing more stress that you can handle. I think people massively underestimated how emotional debt becomes once life stops cooperating. Because at first, leverage feels exciting. You feel ambitious, you feel productive, you feel like you're finally building wealth. And social media makes this way worse because everybody online acts like if you're not scaling aggressively, you're somehow failing at adulthood. Meanwhile, some of the healthiest investors I know grew painfully slowly, like suspiciously slowly, but they also slept well at night. Their relationships stayed healthy, they weren't emotionally collapsing every time an HVAC unit was making a sound. And that matters because leverage doesn't just amplify returns, it amplifies pressure. And life has this incredible ability to stack every problem into the same month. Tenant leaves, roof leaks, insurance jumps, property taxes increase, and honestly, nothing humbles a person faster than confidently buying a rental property and then spending Saturday night on YouTube searching how hard is it really to replace a water heater myself. That's when real estate starts developing your character against your will. Mistake number 4. Buying a property that doesn't match their life. Nobody talks honestly enough about operational stress. Everybody just loves the idea of passive income, that is until your tenant calls during your date night, until contractor starts fighting in the group chat, until you realize that your brain is literally never fully relaxed anymore because there's always some weird property issue floating around in the background. And honestly, this is usually the moment people realize that they didn't buy freedom, and because they bought responsibility with granite countertops instead. That realization hits hard because social media only shows cash flows and equity and financial freedom. Nobody shows Home Depot receipts, stress acne, or somebody silently staring at Excel at 11:47 p.m. wondering why their passive income property somehow created more emotional labor than their actual job. And honestly, not everybody wants the same version of wealth. Some people genuinely enjoy heavy operations, while other people would happily make slightly less money if their life just felt calmer. That is okay too. There is no trophy for owning the property that stresses you out of your mind. And mistake number 5, spending money that doesn't exist yet. This one destroys people quietly because the market goes up a little, maybe the property appreciates, maybe they refinance once, and suddenly they start emotionally spending future money before it actually exists. Bigger car, more expensive apartment, higher monthly lifestyle, more pressure. And honestly, I understand why people do this because progress feels amazing, especially if somebody spends years being financially insecure. But markets change, and when somebody builds a permanent lifestyle around some temporary conditions, things unravel fast. This is why people who survive multiple market cycles become weirdly obsessed with reserves. Not because reserves are sexy, they're actually incredibly boring, but reserves buy breathing room. And breathing room is the most underrated luxury in investing because desperate people make emotional decisions and calm people usually make better ones. And you know what's funny? The longer people stay in real estate, the less this business becomes about property and the more it becomes about emotional control. Because every cycle creates the exact same move: excitement, urgency, confidence, stress, and regret, over and over again. And honestly, the people who usually survive long-term are not always the smartest people in the room. And usually, they're just the people who learned how to stay calm while everyone else was just emotionally speedrunning financial decisions. Thank you guys for watching. Drop your comments below. Tell me what mistake you think I didn't mention and is worth mentioning. See you guys next time, and don't forget to click like and subscribe.